Good afternoon, sir.
Good afternoon, Rishi.
Good afternoon, sir.
Welcome everybody to today's FEDI monthly discussion forum. As you all know that the topic which we have chosen for today's discussion is the recent phase of high volatility in the FX market and how to deal with the level of uncertainties which are going on. And this month's discussion we are having in association in coordination with the FIO, as you all would be knowing. And for that, at the outset, I would like to convey my thanks to Rishikant Tiwari for working together with us, for giving us this opportunity to work together and then present the market views to all the exporters community. So once again, welcome to the forum. And as you all know that global market has been going through some serious upheaval, some serious dislocation, not just the global FX market, but the all markets altogether, right since 2020, with the onset of COVID-19 epidemic, and we have gone through some major dislocations, and especially around end of 21, when we were thinking maybe that worst is over, the world got hit by new geopolitical concerns, and because of that Russian invasion of Ukraine, that set in a new change of disturbances, new chain of disturbances, as a result of which the market continued to be in a very highly volatile and uncertain phase. And this time, maybe the Indian FX market also has got a major hit because of the various reasons, direct, indirect implications of whatever is going on in our neighborhood. We have seen that despite in the COVID, the market had demonstrated a great degree of resilience, and India did really well. And exporting community locked in a decent performance, recording the all-time high export numbers of more than 650, more than 660 billion goods merchandise export in the financial year 21-22. And along with that, the services export also for the first time exceeded 250 billion. Undoubtedly, that's a commendable performance. And now what today we are looking at it in the present turmoil which is going on. And we have ourselves also set quite challenging targets for the next year and the years ahead of us. With this kind of situation, exchange rate volatility, which has increased manifold, and the exporting community is struggling with the high input cost fueled by high inflationary pressures, supply chain bottlenecks, and to add to the worries is another factor, the high volatility in the exchange rate. So the today's discussion which we are going to have is that focusing primarily on the exchange rate part. What are the tools available? What is the kind of right strategy? What should be the approach for exporters to at least manage, risk manage, and handle these uncertainties in the best possible, most cost efficient manner? And to help us untangle all these complexities, help us understand it better, we have got with us today Mr. Neeraj Bharti, the Deputy General Manager from State Bank of India. Neeraj is Head of Treasury Marketing Group for State Bank of India. He has got almost maybe 25 years of working experience in State Bank, Neeraj, if I am not mistaken. You started your career at SBI in 1998.
24, right? Yes.
That's more than 20 years of experience, and out of which maybe around 13-14 years has been in the treasury market. And before the present role, I must let you know that Neeraj was handling that interest rate book for State Bank of India, which is by far the largest portfolio of any institution in this country. And with that kind of experience, now he is in charge of the Treasury Marketing Group, where he is advising and guiding the corporate on managing their exchange rate risk. So we are very happy to have you here today, Neeraj. Thanks for joining us. Welcome to the forum.
Thank you, sir.
To start the come to the main topic, Neeraj, what I would like to ask you at the very beginning is that, as we all know, situation is highly uncertain with so many moving parts. Today's market is highly correlated. Anything happening in any segment, any part of the world has an immediate effect on the exchange rate across all currencies. And moreover, it can be one thing leading to another, what we call sometimes the butterfly effect, which sometimes looks like a totally remote event, but that some next day we realize that it has made a great influence on my exchange rate market, my domestic market. With so many moving parts, practically it becomes very difficult to guess what is going to what is going to be the next, if I may use that, black swan events. Black swan events have become so frequent and common. Earlier it used to be very rare events. Now we are getting hit by a new black swan every few months, I think. What is going to be the next big market mover event, especially for the financial markets and the exchange rates? And how long, how as an exporter, as a player in the market who is subjected to these kind of moments, who is exposed to these kind of risk, what are the things I should be careful, I should be watching for? And also, in your opinion, how long do you think the situation will continue to be so fragile and so uncertain? And when do you expect it coming back, more normalcy likely to return to the market? Just maybe a very broad outlook about the market, if you can just share your views with us.
Thanks, Sudhani sir. Thanks, Hinda, for inviting to me for this monthly discussion. And thanks to all FI members to present here. I will congratulate the exporters of this country through this front, because the splendid performance during the last year, and even first month of this financial year. Second month was little down, but still it's far better than what we were expecting initially. As I mentioned, the position in global market is now very fluid. Number of events, COVID, it's down but not out. The risk is still there. When this Ukraine war started, I remember the first news was coming in the newspaper that wheat supply will be affected, because a major production of wheat, a major portion of wheat is coming from these two countries. And then we got to hear some news that some problem in Europe, particularly on gas front, will also be there. But initial discussion, yes, the impact will be very limited. But now we are getting the market that inflation, it's not impacting these two commodity or these two countries. Actually, the whole world is now under the grip of inflation. And that type of inflation, which probably those people who are handling now, people like us, or even someone who is sitting at the central bank at the age of 50, 55, or maybe 60, they may not have any experience to handle this type of situation. Because, for example, UK, we have seen 9.1% inflation, which was seen 40 years back. So obviously, those persons who are handling this, they have wrote these things in textbook. They have not faced it, because it's unprecedented type of thing. Supply chain issue, which was started with COVID, particularly from China, that's down, but it's still not out. There are many issues now in the present style of world. We can call them legacy issue. If they are 2-3 years old, we will call them legacy issue, but that is still there. Crude price, it's very volatile, 130, 35, and then coming back to 110. And most of them are based on speculative news. If US says that India and China is importing a large portion of crude from Russia, much more than our estimation, then the crude fell down by 5-10%. Now it's an estimation. Earlier was an estimation. This one was estimation. There is no fact behind that. It is just an opinion, but the market is reacting on that. We don't know how the central banks are going to react. In India, I feel, my personal opinion is that the reaction of central bank in India, Reserve Bank in India, is very much more mature. And I can quote that in one of the articles, Mr. Soumyakanti Ghosh, Group CEO of SBI, mentioned that Fed need to learn interest rate game from RBI. And actually, I felt that in this scenario, RBI has managed inflation better than any other country, most of the countries. And because of frequent discussion with RBI, they are very clear in their mindset. They know what they are supposed to do. They know what message to be given to the market at what point of time. They are very clear in the market. one point is to be very important to note here regarding the uncertainty, because uncertainty I am mentioning. The figures given by government and RBI, I feel that they are very conservative. 2-3 years back, even 5 years back, the approach of government and RBI, whatever figures RBI or the government was giving, normally market treat them as the best case scenario. Now, since last 2-3 years, my opinion is that government or RBI is coming with those type of estimates which are most conservative. The best example, recent example, is the inflation target given by RBI in last meeting. They have given a Q1 figure of 7.5%. Against that, actual for April was 7.79 and May 7.04. Now, to maintain a inflation level of 7.5% for Q1, the June month inflation should be 7.67, which is not likely because market is not expecting that high inflation, because base effect will come into picture. So it may be the figure which the inflation targets which they are showing, the fiscal deficit figure which they are giving in the budget. I feel that that is most conservative, and market reacts based on the figure. So one thing is very clear: the uncertainty is going to continue. The position is very fluid. Just as sir is mentioning about timeline, all these events are very liquid. We don't know when Russia-Ukraine conflict will stop. It's now entering into 4th month. As per a very same decision, Europe need to close this war before 31st of August. Because if they enter into April with this type of situation, Europe will be in much more greater trouble than many part of the world, because gas supply will become an issue, and it's purely becoming an arm twisting game. Russia is using their power, and Europe using their power. If they need to get this gas supply streamlined for 2-3 months, so if they want to be comfortable in the entering into winter, the war between Russia and Ukraine should stop by end of the August. Otherwise, it will be very difficult for them. Similarly, COVID, etc., we don't know, but based on the market situation, I feel that next 1.5 months is going to be very crucial, particularly for rupee levels. The trend in the market, we may see a change of trend in next 2-3 markets, particularly in India.
Thank you, Neeraj. I think you have covered it pretty well, how the commodity and the oil is feeding the inflation, and especially the central bankers and most of the players today in the market are not used to that kind of thing. We have all, I won't include me and you, at least you come into that bracket. We have all grown up in that low interest rate, low inflationary environment. We are not, the world is not used to high interest rate, high inflation. So we don't know how central banks are going to cope up with this, though so far they have been presenting a very solid, confident statements, etc. Though the views have been changing. Initially, they were not accepting that inflation. They made it look like transitory, and now they are all acknowledging it is here, there to stay, and we have to fight it out. Now the question is whether we can afford to have a soft landing or hard landing. That's where we are. And Frank, as you also mentioned, that probably this is more of a matter of perception. And what I noticed, very important observation you made about that Europe is under pressure for this, and before the onset of the winter, it's in their interest to find a solution. So very high pressure point, a very high probability that there will be kind of serious effort to get over this issue and come back to the more normal situation and find a solution for all these troubles which are there, which is again being fed by the perception, not necessarily by the actual pressure or actual shortages coming into the market because of the sanctions and other things. Now with that kind of thing, if these situations, these things do turn out to be right, what kind of probability would you assign to the possibility of maybe the situation coming back to normal and a reversal? You mentioned that India is in a much better, much comfortable situation. And if the reversal happens, maybe India is going to be the first to get back to the more normal level, to get over all these pressure points and come to the more realistic level. Today, undoubtedly, what we say, exchange rate and everything is at unusually high pressure, unusual high demand because of that FII outflows, because of that all these global strengthening of dollars. Another point which I would like you to comment upon that, whatever we are seeing is not necessarily the rupee depreciation, but this is the after effect of dollar appreciation. It's a globally dollar is appreciating, and that is being reflected in the depreciation of rupees in this market. There's nothing wrong with the Indian economy. With that kind of thing, if we see either more normalcy coming back or people accepting this as okay, everything is already factored in, as long there is no new negative news, market quickly comes back to the more realistic level. Market works on that expectations, not necessarily on the real good or bad. We have already factored in all the good negative news. If the positive comes, that's very good. If no bad, no negative comes further, that also is good for the market. With that kind of situation, do you see the possibility of rupee tracing back some of these depreciation also in the near future?
For that, we need to look into the factors which are putting pressure on rupee, apart from speculative positions, which can change position at any point of time. Last 15 months, now it's continuous 15 months since when the FIIs, FPI are pulling their money out from the Indian bond market. When they have started, probably that was not a correct decision, because at that point of time yields were at quite attractive level. If you look at the yield traded during last 15-16 months, that has come down pretty sharply. But after that they continued, and when this cycle has turned and the yields have started moving up, the outflow is still continue. Now equity also for 5 months we are looking at the outflow. These two are the very major factors. Now the most of the view on the equity, they are expecting Nifty to go somewhere around 14,500 type of level, which is not far off. I think from last low it is just 700 basis points. So that is one scenario when we can expect that in case, and India growth story is acceptable to everyone. Now if India is going to grow with a very strong pace in the years to come, and equity market is at attractive level, if 14,500 is treated as activity, it is just a question of the perception. If market start perceiving that 14,500 is good level, we may see good amount of inflow starting to coming in. On the bond side also, now SDLs are touching 8%. GSEC has touched 762 3 days last week, and now coming down to 740. So again, these type of rates are quite attractive. Only thing that the differential with US is may not be sufficiently attractive. So if US will start moving down also, this will become attractive. And for this question, I have because I was a trader, so obviously I have a lot of interest in charts, etc. I have observed that since 91 to 2007, I have started from 91 because it was opening of economy. There are two cycles when rupee has depreciated sharply during continuous 2 quarters, followed by sharp appreciation. Since 2007 to 2022, almost similar period, 15 years, we have seen similar 7 cycles. So first 15 years, 14 years, only 2 cycles, and then next 15 years, 7 cycles. And out of these 7, 3 cycles have come from since 2018. So last 4 years, we have seen 2 quarters where the rupee has depreciated sharply. And then in the following quarter, it has again reverted back and appreciated. So highly possible that this we are going to the 4th such movement, because last quarter and this quarter, if we go quarter on quarter basis, rupee has depreciated quite sharply. And if any of these events, particularly UK-Russian war, if that stops and some sanctions on Russia are compromised, I would not say that it will be taken back, but maybe some sort of compromise like we are seeing in oil and gas, then we may again see good amount of appreciation in rupee in next quarter. Because Indian economy strength, not much questions are there. It's just a question of opportunity loss, opportunity cost of fund. If once the sentiments change with FPI, we may see a good amount of appreciation. And that is the point where exporters are required to be very alert. Historically, what we have seen in 7 cycles, which I have mentioned since 2007 to 22, every time 2 quarters, whatever depreciation is there, rupee has appreciated by almost 50-60% in the 3rd quarter. So we may see next quarter very nearly. That means the next quarter, we may be end up discussing that whether this appreciation of rupee is hurting the exports, how to manage this type of appreciation, whether we are comfortable with this type of appreciation or we are not. I am of the view that we may discuss on this topic in September.
Okay, that's a very interesting thing. Unfortunately, what I have seen in the market, whenever the currency is moving, either appreciating or depreciating, most of the research, most of the commentaries talk about continuous movement in the same direction. Rarely you find somebody talking about the trend reversal or the turnaround happening, and we all know turnarounds do happen. And first time I'm hearing a trader or maybe a banker talking about the turnaround, which is a very important. And if I may just summarize the key points which you have mentioned, that maybe the worst is almost there. I won't say the worst is behind us. Worst is almost there in terms of the capital outflows, in terms of that FII outflows, etc. Whatever was there. Inflation we have already seen. Interest rate hikes have started happening, and now equity as well as the bonds, the fixed income, the levels look quite attractive. And India undoubtedly continues to be one of the fastest growing large economy in the world, which makes it an attractive investment uh, ground for attractive investment vehicle, where people would like to globally would like to place money on that, with that kind of thing. And another point which you made on the technical analysis also, that is also interesting. Basically, whenever we have seen these kind of rapid depreciations, which happens mostly because of the, not necessarily because of import or export figure has changed, that's the same, happens mainly because of the capital flows, and capital flows can equally quickly revert back also. And now the ground or the time is looking pretty good for the capital flows to revert back. The possibility of that happening is pretty high. With that kind of situation, you are expecting that there may be a high degree of probability for the rupee to revert back some of the losses, recoup some of the losses which we have seen in the last 2 quarters. With that kind of situation, what should be the strategy for exporters? And frankly, why I'm asking this, because if I'm an exporter, I have seen that rupee has depreciated by almost 2 rupees, 3 rupees in the last few months. And I would be more than happy to hold on my inflows, to hold on my conversion, hoping that the trend will continue. And would that be the right strategy? Or maybe you feel if we are almost close to the worst possible situation, or is it the time to now go and lock in and crystallize some of the conversions for the receivables, or convert some of the dollars which we are having? What should be the right approach?
I think it's better to reduce the risk when we are uncertain about the market. The best strategy in this scenario, I will suggest for the exporters particularly, to remain stay hedged. Now, how they want to hedge, how they want to get themselves insured, which instrument to be used, that's a different question. But stay hedged is the basic formula in this type of scenario, and not only in terms of currency. Currency, obviously, at the same time, the stability of price of commodities. So if you have raw material issue, then enter into long-term agreement, at least for 1-2 years. Nowadays, 1-2 years is also long because cycle is changing very quickly. Then the orders you are in hand, make it sure that these orders are not going to be cancelled. These are continuous at the same terms and condition. And hedging of currency and interest rates, particularly for next 3 to 6 months. Exporters, is very important to get hedged for the short term. And the benefit of to exporters in India, they are getting some extra premium. So if they book for a 3-month forward contract, or if they book a 6-month forward contract, they get a price which is still better than the spot. So that's an additional incentive for any developing country where interest rates are high. So the best strategy at this point of time, I will suggest to stay hedged.
So basically, whatever positive move we have seen in the last few months, this is the time to pocket that, time to lock in that. Otherwise, the risk is that some of that may slip away or slip out, rather than waiting for the better times. Like we say in that trading lingo, the take profit situation, that's where we are right now. That's what you feel. There's the time. And what you're suggesting, maybe to be on the safer side, it is better to stay hedged even for my near term 3-6 months, 1 year kind of receivables, etc., because we are not expecting the downside to continue to be at the pace, or maybe to be higher than what the forwards are prevailing, though the forwards also have come down considerably. But still we expect, even if the depreciation or nothing happens, at least we'll be better off by pocketing the forwards by booking forwards rather than waiting or keeping the position unhedged. That's a very interesting thing, and that's one thing more which comes to my mind. I would like to have your views, especially the comparison with the forwards and the realized spot. What we see very often today, suppose I was looking at the last year, exactly 1 year back, the rupee was whatever level plus the forward. At that time, the forwards were close to 5%. If somebody had booked a forward contract exactly 1 year back, that forward hedged rate would have been somewhere closer to the present spot only. That was something very interesting which I noticed when I went through the previous numbers. That spot was something around 74 plus, and the forward premium for 1 year was 3 rupees and few paisa, which gets us very close to the 78 where the currently we are trading at last few days. Now, of course, 78.20 also we have seen. So that brings me to the comparison of outright forward versus the realized spot. So what you are thinking, maybe going forward, our realized spot may be not better than the outright forward. Is that correct?
Yeah,
So,
that is my opinion at this present time.
all right. And any idea, do you have any indication on that? As you mentioned, in the last few years, 2 times we had seen the reversal, and the last 4 years, 15 years, we have seen the reversal in the exchange rate at least 7 times. In the forward versus realized spot, have there been? I don't think there have been many occasions when the realized spot was better than the forward historically. Any idea on that?
In India, normally forward premium remain stay somewhere around 4%, 3 to 5% range. So unless until the pace of depreciation is more than that,
Right.
normally it's remain in the same range. The speed of depreciation is the same. And one more important thing for exporters, you are in a business of certain goods or services. Now your core activity is something different. So unless until you have a very strong treasury people who is responsible for managing your currency risk, there is not much rational to add one additional risk which is not your core competence. So if you have a, and I will request all the members present here to very clear on that, your accountant or your finance head is not a treasury guy unless until he is responsible only for treasury management. That means he is continuously looking at the markets, he is taking care of the rates. If the person who is managing your purchase and sales order, he is also supporting you in having a view on the currency movement, it cannot be treated as a full-fledged treasury because his priorities are and his interests are differentiated. It's not focused on a particular movement. You need a team, a set of team, if you want to trade in currency or if you want to take that chance apart from your core activity. You need a set of people who are continuously looking at the currency movement, and their main role is just to have a view on currency. They should not have any interest in underlying of the company. If they are trying to match both of them, that is not a team who is supposed to be take independent view on currency movement. So that's a very important point which particularly mid-size and a small exporter should take care of. If you have a full set of treasury people, that's fine. That's why banks are taking those type of currencies, because we have full set of people who are handling only those. Any movement in any currency at any point of time, there is a set of people who are looking at that.
So practically, this is a highly specialized and a technical job, and especially from the exporter's point of view, what you are indicating is focus on the core activity rather than looking at it, unless you have got an exclusive set of people who are looking after managing these things, which requires a lot of investment and is spares resources and the bandwidth to manage this. If you don't have that, maybe this is not the right, you won't advise them to speculate on the exchange rate or to do anything, but rather play safe, and more so during the current phase when the volatility is very high. Under normal circumstances, one can still take a call on that, I would like to go unhedged and other things. But right now, since the volatility is very high, in case a reversal happens, your value can get eroded very quickly, and you are
Very quickly.
already in the positive zone. Why not to lock in that? Why not to crystallize that and move on that? And here, one thing more I would like to point out. Generally, whenever we talk about, we all say rupees depreciating, rupees depreciating. I've come to my initial statement also. If you look at the last 6 months, rupee has depreciated only against dollar. It has appreciated against sterling, it has appreciated against euro, it has appreciated against yen. And I was looking at in 1 year, euro has depreciated. Euro has lost value against rupee by almost 7% in the last 1 year. Sterling has lost almost 7%. Yen has lost around 16% against rupee. So just to say that rupee is depreciating, so as an exporter, I should not hedge it, maybe not the right strategy. The strategy or your action should depend upon what currency you are looking at, what currency pair you are looking. So don't go by the generic statements. And as Neeraj mentioned, probably this is not, unless you have got a specialized team for this, maybe not the right strategy, not the right approach to look for those kind of things. And Neeraj, coming to that, what kind of products do you think in this market makes sense if somebody has to go for the hedges? What kind of hedges one can put in place? What kind of products, maybe outright forwards or anything else?
Starting for your first point, this is perfectly correct that the normal impression what we got in the newspaper or in the market that rupee is depreciating, but rupee is depreciating against the dollar. As you have mentioned, rupee has actually appreciated against euro and pound. It's appreciated almost 3% in a quarter against euro, which is a good percent. 3%, I think many of the exporters has a margin of 3-4%, 5% type of thing. As far as a strategy to hedge the risk is concerned, that's heavily depend on the corporates. What type of corporates are there? What is the risk structure? What is the structure available with them? And what is the risk taking capacity? The traditional and assumed to be risk-free product is forward contract. Although forward contract is not risk-free, but it is better understood by most of the customer in India. And the regulations are very simple. So forward is one of the best tool available in India. If the customer wants to take some calculated risk or some wants to take some chance, it may depreciate further. So I am of the view that rupee is continuously depreciating and there is no reason that it will appreciate. That's why I don't want to lock my rates by booking a forward. Then they should look at the options. I was looking at the option price. The vols are particularly short-term vols, 1 month to 3 month vols and 3 to 6 month vols are at a very low level. 3 month vols is being quoted at 4.3%. 6 month vols is quoted at 5.1%. So while looking in terms of premium, if we book a forward contract of 6 months, we are getting 105 pesos. So looking at 78.20 rate, a forward contract will be somewhere around 79.25. Now, if a customer takes an option, plain option for 6 months, he will get a confirmed rate of 79.25, guaranteed rate, and then he will get the protection also with a premium of 1.25 paisa. So practically by paying 20 paisa extra, a customer can get a protection. If rupee depreciates further, goes below beyond 79.25, he will get the market rate. And if it is going to appreciate, then at least he is assured to get a rate of 79.25. So if the customer is comfortable, if they have sufficient permitted risk management policy, if they have a team to take care of those things, and if they have confirmed underlying, they can go for options or range forward also. Range forward in India, that is treated as a relatively complex product since long, since the start of the derivatives in India. But I am never able to understand why range forward is treated as a complex product. If we look at range forward as a single product, I am not looking at breaking that into two parts. Range forward is nothing but a pure forward contract with a range. In forward, we fix a particular rate. A range forward, we fix a range of rates. So range forward is also a very good product for customers. As far as option is concerned, I am looking at the question. Someone has put a question to give little more information on option contract. Plain option is a type of insurance, life insurance. If I am taking a life insurance, my intention is to get the money back in case any accident happen. I am not intending to get the money back. If something happened, then only we look to get the insurance amount or the insurance money back. No one likes to get an insurance with the intention of getting the money back. It is just in case of any casualty, any eventuality happening. Similarly, when you book an option contract, the psychology should be same. You are ready to pay that much amount of premium. If you are not ready to pay the premium, there are structures to reduce the premium. Range forward is one such example. Seagull is such example. Now RBI has permitted a number of products. So you can reduce the cost, but once you ready to pay that premium, the psychology should be that, okay, I have paid this cost, this is right now from my account. Now I have to look at the outcome. If you try to analyze every transaction after it getting matured, then you will end up taking a wrong decision. And one thing very important, particularly for those who are not in any type of derivative contract, including forward contract, if you are not able to understand the product completely, ask your banker to explain it. Without proper understanding of any product, whatever it may be, one should not enter into an agreement. Forward contract, I always link it to the agriculture business. We have a history of, I think, more than 1,000 years. When if I have, say, one mango tree, I can sell it for 10,000 rupees for 5 years. Every year I will get 10,000 rupees, irrespective of what product, what quality of product is coming on the tree. So that is the best example of simple forward contract. Whether the mango tree is giving some fruits or giving very good products, you are going to get the 10, I am going to get the 10,000 rupees only. So the forward contract is similar. Once you book the rate, you will get the same rate irrespective of market movement. So once you book the rate, after looking at your cost of production and your prices, whatever rates you are getting, you should be happy. Unless until you are going to cancel that, you are not going to take any hit on that. So when the customer starts thinking that, okay, I have booked this forward contract, I got 80 rupees. Now, if I don't have, if I would not have booked that forward contract, I would have got 80.25 or 80.50. Then this psychology comes in picture that I have lost 25 or 50% by booking a forward contract. And then people start taking other opinions or start going beyond hedge and don't taking any hedge. Now, at that point of time, generally customers forget that they are losing 25 or 50% by taking a decision. By not taking a decision, they may end up losing much more than that. If rupee has depreciated by almost 6 rupees in the last 2 quarters, it can appreciate easily by 3.5 rupees in next 1 quarter. So for saving this 25 or 50%, we are actually taking a much higher risk, and that will directly hit our capacity to export. So that is very important to keep in mind. Is we are going for options. There are various type of options. All the options are basically combination of plain option. Plain option is simply an insurance product, and the combination comes to reduce the price. If you are ready to reduce the price, you must understand what is the additional risk you are going to take. If you are comfortable with that, then only one should enter into the derivative contracts.
Thanks, Neeraj. That was, I think, very lucid explanation. And one point I would just repeat, you mentioned that don't get into the product unless you understand it. I think the same applies for that. Don't speculate in the market unless you understand it. And I don't think that for any business, unless you have got the specialized team to look after this, it makes sense to speculate on the market. Instead of that, please focus on your core business and the core activity, and then try to stay protected, hedged to the extent possible. So one last thing, Neeraj, before we open it up for any questions, if anybody might have, I would like to ask, would you like to suggest something in terms of borrowing? Should people go at this point of time, exporters, if they're raising export finance, export credit, should they go for the rupee export credit or maybe the foreign currency, PCFC, etc.? In this kind of market, what would be the right approach or right strategy?
In this type of uncertain market, I will suggest to go for export credit in foreign currency, the currency in which the customer's exports is there, because that will reduce the risk. You are raising your fund in foreign currency. Obviously, the cost of foreign currency is also low. Normally, PCFC right now people are getting around 2 to 4% depending on their rating and relationship with the bank. And the currency risk is much lower because your cost of production and your realization are in the same currency. So currency risk is much lesser. So it's always advisable to, if they have access to, and most of the exporters have access to these foreign currency funds. So if it is available, better to take in foreign currency, particularly for this volatile time when we are not very certain about the market.
So again, I think the ultimate goal is again the same: reduce your exchange rate risk. By going for the foreign currency borrowing, you are neutralizing your exchange rate risk and also getting the lower interest rate. And somewhere maybe one can also look at the comparison between the forward and the interest rate differential, and based on that one can take a call on this. So with this Neeraj, if it's okay, I would like to maybe take few questions. Some people have raised their hand. If I may just allow it. I think, Mr. Dev, your question was already answered on option, what we have said. If you can lower your hand unless you have got something else to say. And in the meanwhile, I'll request Mr. Ambalavanan, if you have something to say, please, you can talk now, sir.
Sir, actually, this is a different question, not related to any hedging and forward contract. Sir, we are having an issue with our bank for getting the BRC for the full invoice value. If the invoice was given for factoring facility by overseas banker, we are exporting to UK. One of the UK bank is giving the factoring facility, and they are reducing the factoring cost while remitting the funds to India. We are learned from few that we are eligible for getting the full invoice value BRC. Bankers are telling they will give the BRC only for the received amount, net received amount. We need your thought on this, sir, if
Uh,
possible.
I'm sorry, Mr. Ambalavanan, this may not be the right forum for
Yeah, yeah,
this.
yeah, yeah. I know, but
So
anyway.
I take your point. You have already taken it up with FIO. Maybe through
Mm,
that, FIO can help to reach out to the
mm,
banker and
right.
can be addressed through that forum.
Okay,
Because
okay.
it is, unless it goes to the right section, you may not
Mm.
get the satisfactory reply on that.
Noise, noise,
Okay.
noise,
All right.
noise.
So next, I'll say maybe Mr. Vilas Patkar, if you have something to say, please, you can go ahead now. Yes, Mr. Vilas, you can unmute yourself now. Sorry, we are not able to hear anything right now. And next, I think maybe the person who has raised his hand is Mr. Vikram Murarka. Vikram, I think you should be on the other side of the table, but still, let's hear.
Thank you so much for this opportunity to place a question to Mr. Bharti. Thank you so much for all the views that you've given. My question is related to the situation regarding the Russian ruble India-Russia trade, where a number of companies are having issues with payments to Russia or even receiving money from Russia. Spot prices are more or less available, but forward prices are very difficult to get, with the forward premium being very, very high. My question is that as per my understanding, State Bank of India is not there in the ruble trade. So one question is, why it is not there? Can State Bank of India be there in the ruble trade? And in the absence there of, what are the options available to Indian companies to facilitate the rupee ruble trade, especially on the forward side?
Sir, to clarify, first, State Bank of India is in ruble trade. We are doing ruble transactions. The sanction is not for the all transactions or all commodities or all companies of Russia. Sanction is selective. So we have a team of officials who are looking at each and every transaction. Each individual transaction is being looked at from the angle of sanction. And if the transaction is permitted, then only we are doing the transaction. And that is the approach being followed by almost all the banks. I think none of the banks in India will take a chance on this type of regulations. So first thing I will suggest, if you are doing a transaction in ruble, check with your banker whether this transaction is permitted or not. Particularly for exports, it should not happen then that the goods have been sent and then the remittance is stuck somewhere in the fact, and then it becomes a problem. So first thing, that State Bank of India is there. The forward rates that are high and that are expected to be high. Once the sanction is applicable, each transaction or the future of the transaction, we don't know what kind of sanction are going to come in the next 15 or 30 days. So entering into a forward contract becomes a very risky business. That's why the premium high. If you remember, when this sanction was declared, when this war has started, Russian ruble quote was being quoted in the terms of 10 rupees spread. That means if you want to sell $1 against ruble with me, I will sell you at 110, sell you at the cost of 120 rupees. I will buy from you at a rate of 110 rupees. That was unheard type of thing in this present world when the quotes are in even less than quarter paisa. But that happens because no one was sure that if I am buying a transaction from buying some ruble from you or selling some ruble from you, whether my bank is going to face some sort of sanction because of just a very small transaction of $5 also. But if that comes into regulatory framework, then that's the problem. So this forwards is high because of that risk, and till the time these sanctions are continued, I am not expecting this forward to come down any sharply. That risk will continue to remain there. So be very cautious if you are doing a ruble Russian trade. Check with your banker whether it is permitted or not permitted, because once the fund is stuck somewhere in effect, it's very difficult to get it through or get it reversed also. Equally difficult to get it reversed.
Thank you so much for this. May I be allowed a follow-on question, or can I ask the question later on offline if you think that is more appropriate? I do not want to take up more time.
I think, Vikram, you can take it offline. That would be better.
Thank you so much. I appreciate it. Thank you so much.
Thank you very much. Next, I would request Mr. Dev, if you have got something to say, because I still see you raised your hand. Please go ahead. If you can unmute yourself now. Yeah.
Yeah. Good afternoon, sir. Thank you for the valuable information you provided us. I had a question regarding the hedging and the forward contracts which you are discussing. Currently, we are following a staircase hedging. Like every 25 bips, we are hedging our positions for the exports. So that is a better way to hedge the currency, or the forwards one which you told, like for 1 year forwards are available a premium of 3 to 5%. So what will be the current good strategy to go for hedging a currency as per the current market scenario?
As I mentioned earlier, the strategy to hedge the products which are to be used for the hedge is completely depend on the company and the comfort of the person. If you are, I'm giving a very simple example of a simple plain forward contract. Now the spot is going at 78. You have booked a 6-month contract of 79. On the date of maturity, rupee is at 79.50. So the person who is booking this forward contract, or the person responsible for profit and loss of the company, may look this transaction in two ways. Number one, you have booked your forward contract at 79 after looking at your cost of production, your realization, and so you are happy with that rate wherever the market. At least you are free of the blood pressure and tension in the last 6 months. Other person can look at the same transaction. If I would not have booked that forward contract, I would have sold my dollars at 79.50. So the reaction of the same event by the different person or the different companies can be different. So what type of structure you have, what is your priorities, that is very important to decide at what point of time or what strategy should be followed. For example, in equity market, many people follow the principle of averaging. When the market will come down, I will average it. That may work or may not work for them. That is their call. No other person can take that call. So what I will suggest for this, you can contact your banker. We have a marketing team sitting in different centers. We have marketing team sitting in 7-8 centers. Similarly, other banks also have that their marketing and advisory wing. You can contact your banker. I will advise you to remain in constant contact with your banker. If you want to come to SBI, we have an advisory team. You can contact us. We provide services to non-customers also. Obviously, expecting that at some point of time they will become our customer. That's common. And that is a strategy of most of the banks. So you decide which bank you are comfortable with, where you have confidence, take their opinion. You can take this view on transaction wise. You can take this opinion on the as a policy matter. But one thing I will definitely suggest: policy and strategy are two different things. If you have a policy of booking forward contract for each transaction, or booking option contract, or keep it open, continue with that policy for some time. Policy should not be changed on every quarter. If you are changing your policy at every quarter, you end up with a wrong policy in your hand. You fix a policy and make your strategy as per that policy, in line with that policy. Strategy you can change. If the market is moving, if the market is changing, you can change your strategy. But policy should not be changed every quarter or every 6 months. That should be a long term. Because wherever we have seen that companies are facing problem because of their decisions about the currency, mostly we have seen that either there is no policy, or the policy is being changed at the whims and fancy of the 1 or 2 person who are generally the promoter or the all in all CEO type of position in the company. So my request is simple: remain in touch with the view. Now views are available from many banks. You can check where you are comfortable, make a policy and stick to that policy. That will definitely help in long term.
Sure, sir. Thank you. Thank you very much for your valuable advice, sir.
Thanks, Neeraj. Last two questions I'll take. I'll just check it up. Mr. Vilas, if you are able to unmute yourself, just we'll wait. You can unmute yourself now. I think there's some problem on that. So I'll go to Mr. Vipin. Vipin, you have raised your hand. If you can ask your questions. You will have to unmute yourself first. Not happening. Neeraj, would you like? Yeah, Vipin, you are unmuted now. You can. No, it's not. It's not. Neeraj, would you like to comment upon? There's a question about the interest rate. What do you expect the Euribor and SOFR to behave going forward, and what should be the corporate hedging strategy for long-term loans?
Long-term loans, that means mostly in form of ECB or foreign currency term loans.
Yes, I believe so.
When a corporate is, ECB is a perennial problem for India, because when a corporate take a loan, they obviously take the cost of hedging into consideration. And the main purpose of taking a foreign currency loan is to get a loan at a cheaper rate than what is available in India. Now, if the purpose of taking a loan is to reduce the cost of funding, then why we keep it open at to take the currency risk? That's or even interest rate risk. That psychology I never able to understand. If you have a calculation that in India you are getting funds at say 8%, and by taking an ECB and after complete hedge, you will get at a rate of 7%, you are, or 6.5%, you are making a clear-cut arbitrage of 1.5%. That strategy has to be followed. When you are taking the ECB, you have to hedge it immediately. And if you are interested in taking that risk, again, make a policy when you are going to hedge that. If you want to keep that open, expecting some appreciation in our currency or some coming down of cost or interest rate, then you should have a very clear-cut stop loss. Okay, I am comfortable. I am making a arbitrage of 1.5%. If my arbitrage is going to come down by 50 basis or 100 basis, now my arbitrage is at 7.5 and 8%, only 50 basis. Then I will hedge it. If a customer is keeping that open, that is like sitting on a time bomb. That's never advisable. Either you hedge at this point of time of taking the loan, or you hedge it as per your policy. The company should always take care what is the amount of risk they want to take, expecting some benefit. If there is no stop loss, we have seen companies. I have an example of that's a relatively old example. A company which has taken loan somewhere around 7.5% in ECB terms. Those days rates were higher in India. Ultimately, they end up paying 22% interest because they have never hedged. And by the time they decided to hedge, the rates have moved up. They end up, when they have actually started thinking of hedging, the cost of fund will be somewhere around 14%. Then they told that 14% hedging at this level is not advisable. In India, I would have got funds at 10%. I have gone to take an ECB because I was getting something better. So I will not hedge. And ultimately, they end up paying 22.5% of rate of interest. So that type of thing is very risky. ECB is a very good route available to because funds are available abroad in plenty of funds. India is always capital scarce company. So if someone is taking ECB or foreign term loan, that is very good thing, but it must be hedged or keep it open with a clear-cut policy. Once that level breaches, there is no review of that policy. Policy should be fixed. One can make their strategy, but change their strategy, but not the policy. So if a company has decided, if my arbitrage will come down by 100 days, I will hedge it, you have to immediately hedge it. Cannot wait for some longer time. And obviously, when there is a question of hedging, the decision, the money belongs to the company. So the decision has to be taken by the company. That's why I mentioned earlier that if the company or the officials of the company are not able to understand that product, they should not enter into that. It's your money. We are advisors. Whatever trying you give me deposit at 4%, I will give it. So similarly, in a forex transaction, whenever forex transaction happens, banks are intermediaries, they will try to make some money, and that is their business. Your money is to protect your underwriting. So always take care that ECB is very good route, or any foreign currency loan is very good route, but keep a hedging strategy in very clear picture.
Thank you, Mr. Sharath. I think you got your answer. The gist basically is that, as Neeraj mentioned earlier, also stick to your policy, stick to your strat. Don't keep changing the policy or the views at very frequent intervals. If the original idea was to cost saving because you're getting at a lower rate, you should have hedged. If not, then better go for with the stop loss, and instead of speculating or taking a market view on that. With this, I'll once again convey my thanks to you, Neeraj, and we are already running behind schedule. So I'll just hand over to Rishikant. Maybe if you have got something to say, you would like to comment upon. Rishi, over to you, please.
Thank you, sir. Good afternoon and warm welcome to everyone. Once again, it was a very interesting interactive session. On behalf of Federation of Indian Export Organization, I extend my sincere thanks to Speaker of the Day, Mr. Neeraj Bharti ji, for not only sharing his invaluable time with us, but also enlightening us with his commendable talk on the subject. I extend my sincere thanks to Ashwini Sindhwani sir, who always makes a good attempt to create an equilibrium between the authorized dealer banks and export fraternity side. I extend thanks to the entire team of FEDI who have made this today's session successful and very interesting. There are few key takeaways for exporter through today's session, which I have observed. One, which Mr. Neeraj Bharti ji has highlighted, that export finance should be done in foreign currency instead of Indian rupees currently. And we completely agree, because it is in sync with the policy repo rate, because earlier it was 4%, but in the recent month, the regulator has increased it by 40 basis point to 4.40, and now it is at 4.90. So in spite of interest equalization benefit of 3% for MSME manufacturer and 2% for merchant exporter for 410 eligible tariff lines, there is a possibility that export finance in foreign currency would be much more competitive than in Indian rupees. The second key takeaway is something which was highlighted by both the dignitaries, that unless and until exporters don't have a specialized set of people who can handle derivatives, the currency risk should not be explored by them. Instead, necessary and appropriate advice should be obtained by the concerned authorized dealer bank. Third, although our foreign exchange reserves have come down by around 34 to 36 billion dollar in the recent months, but since government has shown a good amount of thrust on infrastructure, we anticipate that there may be good capital inflows in the future years, which may again increase our forex reserve. And as Sindhwani sir mentioned, that we should not take it as rupee depreciation, rather we should take it as dollar appreciation, because if we observe the pandemic year, that is 2020, although rupee was depreciating during the second and third quarter of 2021, it started stabilizing in the first quarter of 21-22, and it was around 73 during the middle of June 2021, and today, of course, it is at 78. So what I mean to say that there is a high possibility that rupee will again bounce back, unlike a lot of anticipation or prediction by the economists that it may cross 80. So there are a lot of positives, and as far as export as a sector is concerned, we have already surpassed the last year target of $400 billion by registering $417 billion of merchandise exports, and the 2 months of April and May have again surpassed the monthly target by registering around $38 billion of merchandise exports during April and May. So we are heading in a fast pace to the total target of merchandise exports for the financial year. Last, but I would like to extend my big thanks to the wonderful participants who have joined with great enthusiasm. And there were more than 125 participants during the session. I once again thank everyone, Sindhwani sir and Neeraj Bharti ji and the entire FEDI team and my colleagues from FIO who have made this today's session successful. Over to you, sir.
Thanks, Rishi. Thanks for your continuous support and working together, coordination, and we hope to do more such programs in future. And thanks, Neeraj. Thanks for sparing time and joining us today. And thanks to all the participants for their contribution. Thank you. With this, we just come to an end for this. Thanks and bye. Have a safe trading, safe exporting. Thank you.